Hello and welcome this beautiful Monday morning to Market Insight. I am Lavina Emma. So over the weekend, the Central Bank of Nigeria sold one-year open market operation bills to foreign investors. This was to increase the foreign interest rates and also increase our foreign investment portfolio in the economy. Now, the profits from this open market operation bill rose up to 27.3%, which is quite impressive, as the Central Bank of Nigeria made over 1.01 trillion naira profits on selling these open market operation bills. Now, how does this impact the broader Nigerian economy, considering the recent surge in inflation? I know lots of us have questions on these issues because we always know that every now and then the Central Bank of Nigeria is creating opportunities, more investments, foreign investment opportunities to be precise, to help us with our inflation. But we want to know how this directly affects our economy and the inflation situation in the economy. So to discuss this with me, amongst other issues, is Professor Mike Obadan. He's a professor of economics and the chairman, Goldmark Education Academy. So he'll be joining us online via Zoom, and I'm going to be discussing how this will affect the Nigerian economy. We are all looking for a solution to inflation, and previous guests have also mentioned in the past that investments in our infrastructure, investments in our agricultural sector, direct foreign investments also in other sectors of the economy will help to curb inflation in the country at the moment. So let me connect with my guest. Professor Mike Obadan is a professor of economics and the chairman, Goldmark Education Academy. Welcome to the show, Professor. So like I mentioned earlier on, I want to know how this will impact the selling of the open market operation bills, how this will impact the broader Nigerian economy, considering the fact that we currently have inflation at 29.9%. Professor, your thoughts, please.
Thank you very much. Let me say that the open market operations bill, or simply OMO bills, is a special instrument, monetary instrument that was designed a few years ago by the Central Bank of Nigeria to attract largely and mostly foreign capital inflow, that is, of the portfolio investment variety. And the essence is to be able to, beef up the stock of external reserves of the country with a view to, helping to manage, the exchange rate. When the country has plenty of foreign stock of external reserves, then it's in a position to use foreign exchange to intervene in the foreign exchange market to be able to achieve an exchange rate that is not so depreciated as we have today. And, of course, if we achieve that rate, to be able to stabilize the exchange rate at an appreciated level that will not impact so much on inflation. Well, let me say that in terms of impact on inflation, that the open market rate, OMO rate, which is about 21% or thereabout, aligns with the monetary policy rate of the central bank, which was increased last week at the Monetary Policy Committee meeting from 18.75% to 22.75%. That is by 4%. It's definitely inflationary because it's a monetary instrument that is expected to tighten financial conditions in the economy. That is to say, reduce the money supply with a view to fighting the monetary type of inflation. So invariably, like other interest rates of commercial banks, particularly the lending rates, we expect, that once the lending rates increase, it will increase the cost of lending, cost of borrowing, and then invariably, perhaps, will affect the cost of production of various types of enterprises, that borrow money from banks to produce goods and services. So invariably, the inflation rate is likely to go up when commercial banks increase their lending rates. And the essence actually is to more or less dampen the rate of credit creation and then money supply. So it's not the OMO rate as such, that is contributing to inflation, particularly as, the funding or borrowing is done by, government, through foreign investors. So definitely there is an inflationary impact of the various monetary policy instruments, including the latest, increase in OMO bill rates.
Okay, yes, I understand what you have said, Professor. Yes, but we also saw that expectedly when they sold this one-year OMO bills to foreign investors, they actually surpassed the expected yield. They were expecting about 355 billion naira, but it surpassed that. It went on to 1.01 trillion naira. So do you think this move aligns with the Central Bank of Nigeria's policy to address the current inflation in the economy, actually? Yes, you also mentioned that investors will actually be the one investing in our economy. They also need to, it's also increase the lending rates. But do you think it also aligns with how they will solve this inflation, current inflation in the economy?
Well, let me, like I've just explained, the OMO base rate is not a policy instrument to address inflation, reduce inflation. There are other measures that could be, taken to address the current galloping inflation. The purpose essentially is to attract foreign capital inflow, which can help to stabilize the exchange rate. It's possible that as a part of, as a side effect, that inflation could increase. But like I said, it's not because of the activities of commercial banks who would have responded, as expected to the monetary policy rate hike of last week. They are expected to increase lending rates. Lending rates increase the cost of borrowing and cost of production, among other effects. So that's what's likely to, inch up, the rate of inflation. So I believe that the central bank will be pleased with the outcome of the OMO auctioning that was done, especially to attract foreign investors.
Okay, thank you for that, Professor. Okay, so given the high demand for the open market operation bills at the recent auction, how might this affect liquidity in the Nigerian markets?
Well, no, what will affect? Is it the OMO B rate or the monetary policy measures of the central bank?
How would this actually affect everyday economic businesses in the country also?
No, I beg your pardon. I didn't hear.
So, how this will affect liquidity in the Nigerian market, and how does liquidity tie into the economic experiences of Nigerians, or let me say businesses in Nigeria? Let me just put it that way.
Well, let me say that by selling the OMO bills, it's likely to increase liquidity in the economy. Because central bank has to provide, the money, invariably to do the servicing, as it were. Uh, but what is likely to impact liquidity very significantly is the monetary policy rate, which was hiked, and then the cash reserve requirement, which was, also hiked significantly from 32.5% to 45%. Those two measures are designed to reduce liquidity in the economy, which is adjudged to be so much as at this point in time. And the feeling is that with so much liquidity in the economy, so much money in circulation, that there's a lot of money in the hands of people, particularly, money that is not tied to production, money that some people have access to, and they use it to increase consumption when goods and services production, have not increased. And then they also use such money to speculate against, the naira in the foreign exchange market. They have plenty of money, and they go to the foreign exchange market to try to buy foreign currencies at any price. And so you find a situation that depreciates, the exchange rate. So is there actions, that would cause inflation in the economy? But with the measures taken, central bank expects that the liquidity in the economy and money in circulation will reduce, and then less money will be available to economic agents, to put pressure on the foreign exchange market or put pressure on goods and services, and so, tend to douse, inflation in the economy.
So would you also suggest the fact that we have so much money in the economy and most of these monies are not tied to production, so it might be better for people to actually invest most of the excess funds that they have perhaps in the stock market? Yes, Professor, what would you suggest?
Well, if through the stock market, producers will have access, to the funds to produce, fair enough. But otherwise, we would encourage, such people that have huge sums of what I can call idle money to invest in the productive sectors of the economy, invest in agriculture, invest in manufacturing, invest in transportation, and similar sectors like mining, petroleum, that produce goods and services, and then help to reduce, inflation. Stock market, you saw the recent bubble, in the stock market, a situation whereby perhaps due to market manipulations, the prices of stocks, were rising astronomically. And people knew that there could be a bubble burst at some point, which I think is happening now because of the central bank's monetary policy measures. With the hike in monetary policy rate and increase in cash reserve ratio, what's happening is that lending rates, saving rates of commercial banks likely to increase. And with such increases, investors are likely to invest less in the stock market and put their money, in different monetary instruments in the deposit money banks. I think that must be the reason why, in the last few days, stock prices have trended downwards, and some stakeholders, investors, have been reported to have lost, billions, if not trillions, of naira. So my suggestion would be people that have money for speculation, either in the stock market or in the foreign exchange market, should divert such money to the production sectors of the economy. That is what will help employment, that will help reduction of poverty, will help the growth of the economy, which will make, all of us, to be much happier in terms of improved social welfare.
Thank you for that. Yes, I actually do, because in this country, we're definitely looking for any form of anything that can make us happier with the current situation. I mean, when we go to our local markets or supermarkets and we hear them saying, oh, the prices of these things have gone up, and you're looking at it like, these are things that are made right here in my country, so why did the prices keep increasing? So yes, I do share your thoughts on that too, Professor. Yes, we need to invest more in more productive services, actually, to actually benefit us as people. So Professor Obadan, yes, so with plans, the Central Bank of Nigeria's plans to increase open market operation frequency, volumes, and do you see any side effects on domestic investments and borrowing within Nigeria, and how might this impact on businesses in the country? As you know, most people who are starting out and people who also have their own businesses thriving successfully, they have been able to borrow money from the bank at certain points in time. Yes, Professor, are you still there? Okay, we're still connecting with Professor Mike Obadan, and like he rightfully said, he has suggested that we needed to invest in more productive services instead of just keeping this cash lying around idly. I do share your thoughts on that, Professor. So welcome back. So you actually said that yes, investing in sectors like agriculture, transportation, petroleum will actually benefit us more in this country, and I agree with you on that. So with the Central Bank of Nigeria's plans to invest more in open market operations, and also this will also increase the volume of OMO bills in the economy. So do you see any potential side effects in domestic investments in terms of borrowing costs with Nigerian businesses? Like, do you see any sign of investments decreasing, or let me say borrowing and lending for Nigerian businesses?
Yes, the investors in the Nigerian economy, real sectors of the Nigerian economy, in agriculture, in manufacturing, mining, and similar sectors, may be adversely affected. Not necessarily because of the OMO bills that the central bank, is selling, but because of the aggregate monetary policy measures of the central bank, which have a tightening effect. Let me say this, that the purpose of increasing monetary tightening in the economy is to, increase the cost of borrowing, really. So which means, yeah, new investors are likely to be affected. They are likely to think twice before now taking loans from the commercial bank, because they will think twice and figure out the rates of returns on their proposed investment in relation to the cost of borrowing. If the cost of borrowing is expected to be higher, then you see there is a discouragement of new investment in that area. Even the investors, the manufacturers, producers, micro, small, and medium enterprises that have already borrowed, if the commercial banks, hike their lending rates, is going to affect them, affect their rate of expansion of productive capacities. And it may turn out that some of them might encounter increased difficulty in repaying even the existing loans. In other words, the commercial banks may experience increased default. But that's a likely development. It may not. But invariably, if the policy instruments are implemented as designed and expected, and they reduce the ability of new investors, to borrow, and even the banks themselves, their ability to lend is reduced because they are going to put more of their deposits received in the vaults of the central bank as reserves, idle kind of reserves, rather than being available for productive lending. So the net effect of the tightened monetary policy measures is to reduce the ability of the deposit money banks to extend credit, to lend money to the incentive of new investors, economic agents, to even borrow money. Because borrowing implies credit creation, expansion of liquidity by the commercial banks. And so both measures, invariably have that effect. And, it may not be in the best interest of the economy after all. If, commercial banks cannot lend, borrowers that have already borrowed, they cannot, repay the loans, and the banks themselves may experience, increased, non-performing loans and so on. So the effects, are not really, palatable as such. It's just that the central bank may achieve its objective of reduced inflation, in the economy. And so invariably, normally, there is usually a trade-off in policies. Policies are designed to achieve certain objectives. And when they achieve that, some other costs, trade-offs may occur.